Bueno, buenas tardes a todos. Good afternoon. It's for me a pleasure to make the introduction to this lecture that this year is going to be made by Silvana Tenreyro. I don't know, it's with a little gallega accent. And she's a PhD from Harvard University. She's also professor of the Department of Economics, London School of Economics, director of the JEEA-FBBVA, and former external member of the Monetary Policy Committee of Bank of England, former president of the European Economic Association, commander of the British Empire, foreign honorary member of the American Economic Association, fellow of the British Academy and Economic Society. And then I think I'm going to stop here, Silvana, because otherwise you won't have time to make your speech. And let me now introduce you and to tell you that for me it's a real pleasure to introduce you, and I think I will find my words here. And also, I would like to thank you because you are one of the few women in microeconomics. You know that there is a big gender gap in microeconomics, and you are one of the very few exceptions and a very successful exception. So you are a leading example, and I hope that many young women follow your example. Thank you very much. Today, she's going to talk about the transmission of negative interest rates. Exactly title of the. These are not real my notes, but it's okay. I will make a very short introduction. After your lecture, you will be discussed by Philip Lane. Philip Lane is also well known by all of us. He's also a PhD from Harvard, so two Harvard's PhDs today here. And he's a executive board member of the ECB. He's also in charge of all the economic part of the research economic of the ECB. And as I said, he will be discussing today the talk by Silvana. But before, let me make a short introduction. I hope it's short because we have much to learn from you. And starting with academic literature examining the effects of negative interest rates, this is a relative young literature, as major central banks began implementing negative rates only around 10 years ago. For a long time, academics even thought that negative nominal interest rates, meaning a payment from lenders to borrowers, would not make sense and could not arise in practice. The reason for that is straightforward. With cash, there exists a risk-free asset that always provides a nominal return of zero. Therefore, the argument goes, households and corporations will start holding cash in large quantities rather than accepting negative nominal rates on safe assets such as government debt. The economist John Hicks, for example, made an argument along these lines already in the 30s. However, the effective nominal return on cash is arguably slightly negative if we account for storage costs, meaning that the physical lower bound on the policy rate is not exactly zero. This opens the possibility for central banks to push the policy rate into negative territory and has led to a heated debate in the academic literature on the exact effects of negative interest rates. A crucial question is whether negative interest rates transmit differently and whether they can still be used to provide stimulus to the economy. Many contributions to the literature put a special emphasis on how negative rates affect banks, which are at the heart of the monetary transmission mechanism. Of particular concern in that regard is how rate cuts affect the profitability of banks, and in turn, their ability to grant loans to stimulate economic activity. The theoretical literature typically assumes that the central bank can set the policy rate negatively, but that banks, because of the lower bound on nominal interest rates, are constrained in setting negative deposit rates. In such a situation, a rate cut does not pass through to the funding costs of banks to the same extent as a similar size cut in positive territory could. On the asset side of the bank's balance sheet, however, the remuneration of reserves follows with the policy rate, and so do the loan rates, meaning that the net interest rate margin of banks is compressed. This compression of interest rate margins may potentially reduce the profitability of banks, decrease their net worth, and impair their ability to grant new loans. However, there are also countervailing forces. For example, lowering interest rates can also lead to capital gains on long-term assets. Lower loan rates also increase the demand for loans, meaning that banks may operate with smaller margins but at a larger scale, without profits being negatively affected. Banks might also take on more risk or adjust their business model to be more reliant on fees rather than profits from the interest rate margin. Furthermore, banks might also benefit from a lower need for loss provisions. Theoretical research also highlighted the possibility of a so-called reversal rate. The reversal rate is the interest rate level below which additional cuts are no longer stimulative but become contractionary. The exact level of the reversal rate depends on the strength of the various channels that affect bank net worth, as I mentioned earlier. The idea is that if rates become too negative, the reduction in bank profits and net worth can tighten banks' capital constraint to a point where further cuts lead to a reduction in credit supply rather than an expansion. Until now, central banks did not have to cut interest rate as low as to hit the reversal rate, meaning that for the moment, it is mainly a theoretical limit, the exact level of which is still up for debate. From a theoretical perspective, policy rates cuts into negative territory, therefore, may not be as stimulative as those in positive territory. Based on theoretical models, rate cuts into negative territory have been estimated to be only 60 to 90% as effective as an equivalent cut at higher interest rates. While the theoretical literature on negative interest rates is relatively small, there is a vast empirical literature that sheds light on the importance of some of the theoretical predictions. For example, the damp pass-through to deposit rates has been confirmed. Banks have indeed been reluctant to charge negative deposit rates, fearing that deposits will move to holding cash. However, the impact on profitability is not as stark as theoretical models often assume because of two reasons. First, corporate depositors, who usually hold higher quantities of deposits and for whom a flight to cash will be more costly, tend to be more willing to accept negative deposit rates. And second, banks not only rely on deposit funding but also on wholesale funding where the pass-through is close to full. The pass-through to banks' funding costs is therefore imperfect compared to a situation with positive rates, but the partial pass-through that does arise still reduces the funding costs of banks. Most importantly, empirical research has shown that negative interest rate can still be stimulative for the economy, despite the pressures they put on the bank's profits. While negative interest rates are empirically stimulative in general, research has also shown that there can be substantial heterogeneity in the exposure to negative interest rates across banks. Banks that are more reliant on deposit funding and are more affected by a negative policy rate because of the differences in pass-through to deposit rates and to wholesale funding rates. The heterogeneity in the transmission of negative rates not only depends on difference in bank characteristics. In the case of the euro area, research has shown that heterogeneity in initial levels of deposit rates across countries also implies difference in the transmission in the transmission. Thus, in 2014, some countries in the euro area still had deposit rates relatively far above zero, for example, Portugal and Spain, while others, like Germany, had substantially lower deposit rates. As a result, the transmission of negative rates was different in those countries. In high deposit rates countries, the transmission worked similarly to how rate cuts in positive territory work, because banks had ample space to reduce deposit rates. Banks in low deposit rate countries, however, were not able to reduce deposit rates much before the lower bound constrained them. Given the relatively recent introduction of negative interest rates, the academic debate on the transmission of monetary policy with negative interest rates is not yet fully settled. The current literature suggests, however, that negative interest rates can be a viable tool for the conduct of monetary policy, but in any case, we will learn much more about this issue with Silvana's lecture and then with the discussion of Helen and Silvana. Thank you very much.
Thank you very much, Soledad, for the introduction, and thank you to the Fundación Banco Bilbao Vizcaya Argentaria and the European Economic Association. Thank you. And its journal, JEEA. It's a pleasure to be here. And the title of my presentation is Negative Interest Rates and the Impact of Monetary Policy. And this is joint work with Michael McLeod from the Bank of England and Lucas von den Berge, also Bank of England and University of Oxford. The usual disclaimers apply. This represents our views and not those of the bank. So let me start with the brief motivation for our work. As Soledad said, more than a decade ago, several central banks introduced negative rates to stimulate their economies and offset disinflationary pressures. As we know, the pandemic and the large increase in commodity prices caused by the invasion of Ukraine triggered a surge in inflation and a very sharp increase in central banks' interest rates. But inflation is now more or less back to target in most advanced economies, and policy rates are being cut. In some countries, they're already very low, standing at 0.25% in Switzerland, for example. And against that backdrop, central banks may have to confront again the question of how much monetary policy space there is in the event of a large recessionary shock. Arguably, the prospect of a large increase in military and infrastructure spending in Europe should make a recession less likely, but there are many other factors that will likely weigh down on activity and inflation in Europe, including US tariffs and more generally global uncertainty. So in that context, the three questions we try to address in this work are: first, is negative interest rate policy effective at stimulating the economy? Second, is there a reversal rate below which lending becomes contractionary or contracts rather than expands when the policy rate falls? And finally, how far can interest rates fall? In other words, where is the effective lower bound on interest rates? And obviously now, as Soledad said, we can draw some lessons from the pre-COVID experience, particularly in Europe, and we can use a swathe of models to interpret that evidence and try to address at least the first two questions, and the third will be more speculative. Now, before we get started, let me be clear about what I mean by negative interest rates. We're talking about interest rates on banks' reserves. These interest rates are decided by the central bank. We can think of a central bank as a bank for all commercial banks. Commercial banks deposit their money, called reserves, in the central bank, and those reserves accrue an interest. If the policy rate is positive, the central bank pays the interest to the commercial bank. If the interest rate is negative, the commercial bank pays the interest to the central bank. Now, these policy rates influence all other rates in the economy. For example, if those reserves those interest rates on reserves are very low, banks will have a bigger incentive to lend to households and corporates, or to buy bonds and other assets. So in that way, this interest rate can act as an aggregate demand tool that can shift around demand in the economy. So why should we be worried about lowering interest rates to negative values? Virtually all concerns have focused on their effects on the banking sector. So for example, Christian Sewing, current CEO of Deutsche Bank, argued that they were an irresponsible policy and that they ruined the financial system. This was perhaps a bit dramatic, but he certainly wasn't alone. Many smaller banks, like the German Sparkassen and Volksbanken, expressed disapproval as well. But there were also other voices within the banking sector. For example, Jean-Pierre Moussier, former CEO of UniCredit and head of the European Banking Federation, thought that negative rates were actually a net positive for the banking industry as they stimulated the euro area economy. So the banks themselves don't agree. And this is why the model we will present will feature heterogeneity across banks. And this will allow us to explain these different accounts by different banks. Importantly, as this quote from the former UniCredit CEO hints, the potentially positive effects of negative rates on the economy stem from what we call general equilibrium effects. Negative rates support the economy through various transmission channels, which feed back to the banks. For example, through stronger loan demand or lower loan impairments, and caused, for example, by fewer defaults. So we argue that a limitation of several of the theoretical papers in the literature is that they focus just on the banking sector. Of course, this makes sense because this is where the friction lies. But at the same time, if we only focus on closed economies where all the intermediation is done by banks, we're missing an important part of the monetary policy transmission through which negative rates could still work and stimulate the economy, even if the direct channel through the banking sector is muted or somewhat impaired. So to pick that up, we will develop a model in which banks do some of the intermediation, but there's also a group of firms that can borrow directly from financial markets by issuing corporate bonds. And moreover, we model an open economy, so there's at least another channel of monetary policy transmission, the exchange rate, through which negative interest rates can have an impact on the real economy. To be clear, and Soledad already said some of this, thinking about negative rates is nothing new. There's a long history of thought going back to Silvio Gesell and Robert Eisler. Keynes himself was very torn. He had read and praised Gesell's ideas and thought them very sound, and he devoted more than half a chapter in the general theory to talk about it, but he also found some faults. Recently, Ken Rogoff wondered whether Keynes might have reevaluated his position if he had read the proposal by Robert Eisler, which was taken up recently by Boiter and others. There's another sense in which negative rates are also not new. Despite people's worries about entering into negative territory, in real terms, we've had many periods in which interest rates were negative, as illustrated in this chart with long-time series from the Bank of England. In yellow here, you can see the bank rate in real terms, and in light blue, you can see the real deposit rates in the UK. And both turn negative for extended periods of time. As we know, we do suffer from some nominal illusions, so that might be part of the problem. But to be fair, some of the concerns with negative rates stem from the fact that there's cash, and this is what Soledad was saying, and I'll come back to this point in a few slides. So this is a main issue here. So in the rest of my talk, I'll walk you through some of the key facts about negative interest rates that we think we want our models to speak to. Then I will discuss some of the existing theoretical models on negative rates. They are super insightful, and we have one of the main contributors in the audience here, Rafael. But as we will argue, they miss at least one of these facts, and we will try to tweak those models in order to match these facts. And we will embed that modified banking model in a macro model to be able to carry out more quantitative analysis. So turning to the evidence, fact number one is that in countries with negative interest rate policies, corporate deposit rates have fallen into negative levels, while household deposit rates have been bounded around zero. So this goes back to the question of cash. Why would negative rates be any different from positive policy rates? And cash is the answer here. Cash is a safe asset with a guaranteed nominal return of zero. And as we are taught in many of our textbooks, people would not want to hold bank deposits with a negative nominal return when they have the option to hold cash. And that's probably the reason why household deposit rates haven't fallen below zero in most countries. And this is what we see in the left-hand panel. But for corporates, as you can see on the right-hand side plot, there doesn't seem to be a zero lower bound. And that's probably because of storage, safety, and convenience cost. As a household, you can perhaps do your weekly shopping cash if you wish, but as a business, you can't really buy machinery or pay the wage bill in cash. That's very inconvenient. As a household, you can probably store some of your cash, your money under your mattress. As a firm, you probably don't want to do that with big amounts. You need to buy a safe, perhaps hire a security guard, et cetera, et cetera. This is all expensive. Of course, at some point, firms may choose to buy the safe and hire the security guard if interest rates fall very deeply into negative territory. This physical lower bound due to cash probably still exists, but it looks like we haven't hit it at the levels of rates that central banks have implemented so far. So for the purposes of our model, we will assume that household deposit rates are bounded at zero, and that will be the constraint that we will impose. The second fact is that lending rates have fallen in response to negative rates, but the pass-through from policy rates to lending rates has not been complete. In normal times, we expect the transmission from policy rates to lending rates to be almost 100%, but when the policy rate was cut below zero, the pass-through was mostly around 50% with some variation across country, and these studies are some examples of those estimates. The third fact is that aggregate profitability has not been affected much. If anything, it increased a little during this period of negative rates. Now, with household deposit rates stuck at zero and lending rates falling, it might be surprising that aggregate profitability has not changed much. Actually, as you can see in the graph, return on equity increased in most of the negative interest rate countries. And these are just raw data, but there's no identification here, so this is just the raw data. But most of the empirical papers that do a proper identification exercise also conclude that there's not much to see here. There's a very nice paper by Lopez and co-authors at the San Francisco Fed titled "The Surprisingly Benign Effects of Negative Interest Rates on Banks." And there are several papers by Carlo Altavilla and his colleagues at the ECB showing that, if anything, negative rates have slightly improved bank profitability relative to the counterfactual of keeping the policy interest rates at zero. And this typically, again, has to do with the reduction in default rates and the general increase in demand coming from general equilibrium effects, as I mentioned earlier. Let me go to the last fact that we would like to speak to, which is that aggregate net interest margins have not changed much, but for some banks, especially high deposit banks, the fall has been substantial. So in this chart, you can see that euro area banks' aggregate NIMs, net interest rate margins, depicted in blue, have fallen by about 5 basis points between 2013 and 2019. That's not nothing because obviously banks operate with leverage, but even at the 20 times leverage, this only amounts to 1 percentage point at most. So negative rates can compress negative interest margins a bit, as much of the literature assumes, but it doesn't look big in the data. That said, it does look big for some banks. So for example, German savings and cooperative banks' net interest margins declined by about 40 basis points during this period. These are banks with a high ratio of deposits in their balance sheets. And this weighed quite substantially on this bank's profitability. So in some way, negative rates can be a problem for some types of banks. It's not that visible in the aggregate. And that's the bottom line that we would like to, the model to reflect. So to sum up, these are the key facts we want to have in the model. First, household deposit rates are constrained at 0, but corporate deposit rates and other forms of wholesale funding rates can fall below 0. Second, the transmission from policy rates to lending rates might be delayed and reduced, but it remains positive. Third, aggregate banking sector profitability is not adversely affected and may even improve with negative rates relative to the right counterfactual. And finally, some types of banks, notably high deposit ratio banks, can come under pressure. Sometimes they will have to reduce lending in response, sometimes they won't. So, but as I said, as a whole, for the industry as a whole, aggregate profits didn't fall. So let me highlight here what we view as the main theoretical papers in the literature. These are all super insightful papers, and as I said before, we use them as our baseline to try to speak to the facts and get to the macro model. So all of these papers have the zero lower bound on household deposit rates, which is, of course, a key friction that makes this an interesting problem. None of them matches the fourth fact because they don't have heterogeneity in banks' funding models, which is the key in our paper. The first two papers, the one by Abadi, Ronnemeyer, and Kobe, and the second one by Eggerson, Usrud, Summers, and Wald, deliver a reversal rate, the idea that lending rates actually increase in response to a policy cut in negative territory. And because in those models, banks don't pass negative rates to lending rates, any effects on interest margins and bank profitability tend to be very small, though still negative. On the other end, the second group of papers are Ulate and Rafael Repullios. These two papers deliver very strong pass-through from lending rates, indeed pass-through in Rafael's paper. But they also have a very large drop in profitability, which is something that we haven't seen, as I said, in the data. So what are we going to contribute to this literature? First, we will have channels of monetary policy transmission that circumvent the banking system. In 3 of these models, all the credit intermediation is done by banks. In Abadi et al., there is a capital market channel which allows some firms to borrow directly from capital markets, and we'll have that as well. And in addition, we'll have the exchange rate channel of monetary policy, which none of these papers have because they are closed economy models. But the main message here is that the more of these non-bank transmission mechanisms that you incorporate in the macro model, the more likely is that negative interest rates will be impactful in the economy and will not weigh down on profitability. The second, the reason why these two sets of models come up to opposite conclusions on the effect of negative rates on pass-through and on profitability is that they have different assumptions on how banks price their loans. So in the first two, the assumption is that the marginal funding cost of a loan is the deposit rate. Whereas in the second two, the marginal funding cost of a bond is the policy rate or the wholesale finance rate. So we will argue that what banks do in reality is somewhere in between these two extremes. And we will set a model that nests the two cases, and when we set the parameter to something that we think is more realistic, we will be able to get a model with positive pass-through, but somewhat impaired, and we'll get a positive but small effect on profitability. And the third margin on which we deviate is that we will have banked heterogeneity, and more specifically, we will allow banks to have different funding models and hence different degrees of exposure to the zero lower bound on deposits. And that's going to give us the main wrinkle against negative interest rates. It can actually be bad for some types of banks, though not bad for the aggregate. On aggregate, they will always stimulate the economy and increase profitability. Now, let me be clear about what I mean by the extreme assumptions on loan pricing in the literature. So the paper by Abadi and co-authors, and the early versions of Egerton and co-authors, they all assume that when banks make an additional cost, that has to be funded by deposits. And because deposit rates are constrained at zero, when the policy rate falls below zero, banks' funding costs do not fall. But the return on reserves fall with the policy rate. So even if the bank were to keep the lending rate at the same level and change, the bank's interest margins and profitability would fall. So to keep the net interest margins constant, the banks actually increase the lending rate, and this is the lending rate reversal. The other two papers, Ulate and Repulio, instead assume that when making an additional loan, banks fund that with wholesale finance rather than through an additional deposit. So the policy rate is the marginal funding cost of a loan. So in the jargon of the literature, that means that lending and deposit taking are completely separate activities, or are completely separable. And because the policy rate is the marginal funding cost, the pass-through from the policy rate to the lending rate can be complete or 100%. And that generates the large fall in profitability in these models. Now, there is some also assumption about the size of deposits versus loans, and some of these papers assume that the share of deposits in the balance sheet is larger than the share of loans. We can see here in this picture what the data look like in 2019. In Sweden, the UK, and the euro area, banks had more loans on which they could apply their monopoly power than deposits. Loans here are in dark and light blue, and deposits are in pink and red. And about a quarter to a third of these deposits were actually corporate deposits, which we saw are not, the rates are not bounded at zero. So in our model, we're going to assume that banks have more loans over which they have market power than they have deposits that are constrained at the lower bound. But more importantly, we will have a different way of modeling how banks price those loans. And so let me turn to the banking model to explain that in more detail. So we start with the Monty Klein banking model, which is the starting point for most of this literature. And then I will discuss the tweaks that make the model more realistic. So in this model, there's only one bank. You can think of a local monopolist, which faces a loan demand curve and a deposit supply curve. The bank here is subject to a capital constraint, which requires that a portion psi of its loans be backed by capital. And the people who supply that capital, the investors, require an excess return rho above that policy rate. This bank has also access to wholesale finance at the policy rate I. So the bank's problem is to minimize profits by choosing the amount of lending and deposit taking, or equivalently in this case by setting the lending rate IL and the deposit rate ID. So this problem is simple because deposit taking and lending are separable activities. And we can derive the optimal lending rate, which is here given by this expression. It just equals the policy rate plus the excess return of capital weighted by the capital constraint parameter plus a markup that reflects the monopoly power. And it's simply the inverse of the semi-elasticity of demand. Now, what happens when the policy rate changes here? The lending rate follows the policy rate 1-for-1. So pass-through here is 100%. This is true above 0 and below 0, as lending and deposit taking are completely separable. Of course, once the policy rate falls below 0, deposit taking becomes a loss-making business. So in this model, the bank would actually shut down any deposit taken and become fully wholesale finance. That's, of course, not what happened in practice. Banks continue to take deposits. So to get closer to reality, we need to modify this model. In Ulate's and Rafael's model, they assume that banks are forced to accept any deposits that are offered. And here we will do something different. So the key change we will introduce here is to introduce a funding constraint. This constraint requires a minimum of deposit funding. And there are many ways to justify it through regulation, business synergies, complexity, and so on. I won't have time to talk about it, but there's more in the paper. Now, this funding constraint may or may not bind in normal times, but it will always bind at the zero lower bound, because that's when deposits are unprofitable. So this is our funding constraint. We substitute this into the profit function, and that will break the separability between deposit taking and lending. And this is the new optimal lending rate from the perspective of this bank. And as you can see, as before, it equals the policy rate, but now is weighted by the extent of wholesale funding in the economy. And the other parts are similar. We have the excess return and the markup given by the inverse of the demand elasticity. So if we look at the monetary policy transmission here, if we cut the policy rate, the I, now we get positive pass-through, but not 100% pass-through, okay? And the more deposit funding is required from this bank, the weaker will be that pass-through to the lending rate. So this is a monopolist with the funding constraint. Let's look at what happens when we have multiple banks. Now, the extension to multi-banking is pretty easy in the Monty Klein model. It can be rewritten as a model of Cournot competition between n identical banks. All of the results I just described carry through. The only difference is that now the markup depends on the number of banks in the economy. But the important part at the end is that the monetary policy transmission works just as before with the monopolies. There's no lending reversal, the pass-through is positive and depends on the degree of deposit funding in the economy, the phi parameter. So this model achieves this partial pass-through, but still positive, and there's no problem here. Now, the more interesting case comes when we look at heterogeneous banks. So we will assume that there are two types of banks, one with a high deposit funding constraint and the other one with a lower one. We can write the profit function for this bank, derive the optimal lending. And remember, this is Cournot competition, so there's only one lending rate here. The different types of banks, I have to go back. The different types of bank here decide on different lending quantities, the quantity of loans. But we're still asking here the question of what happens when we lower the interest rate, what happens to lending for type 1 and type 2 banks. Now, the algebra gets very unfriendly here, but it can be seen more easily if we reduce a problem to a duopoly. So just two banks with two different funding constraints. In the horizontal axis in this graph, we have phi 1, the deposit constraint for type 1 banks, and the vertical axis shows the constraint for the second type of banks. And what this is saying, and that's intuition that is also true in the oligopolies model, is that when those funding constraints are very close to each other, there's no reversal in the lending rate. So we're back to the results that we had before. The problem here is if one of the banks has a very high deposit constraint and deposit funding constraint, in that case, say we're looking at type 2 bank, and type 2 bank has a very high phi parameter. So in that case, that bank will experience a reversal in lending, reduce its lending, but there will not be reversal for the other bank. In fact, the other bank will expand and take the market share of the type 2 bank. So bottom line, if one type requires significantly more deposit funding than the other, the higher deposit type will experience lending reversal. But on aggregate, there will not be any reversal. And that means that we shouldn't necessarily be worried about this if the banking system is very reliant on deposit. Only if there's a lot of heterogeneity, we might be concerned particularly if we care about losing some banks with the policy. Of course, there are other policies that a central bank could adopt to make up for the losses, like reserve tiering or some other measure to avoid losing those to avoid a situation in which those banks lose too much market power. So let me stress just one result here. As before, the lending rate will fall when the policy rate falls. And here, what's important is just the average funding constraint for the economy as a whole. So as long as the economy as a whole has some wholesale funding, the pass-through will be positive in this economy. Negative rates can shift around market shares from high deposit towards low deposit banks, but they can lead to an aggregate lending reversal. We can also show that profits in this economy, banking profits, increase in the aggregate. But as I hinted before, profits for some banks might not increase and indeed might decrease. And those are the banks who might see a decline in their lending taken over by the low deposit banks. So quick summary here, we find no reversal in aggregate lending. Aggregate profitability is stable or may increase a bit. High deposit banks can experience falling profits and even lending reversal, but for the economy or for the industry as a whole, that's not feasible within this setup. And that would be consistent with what we saw in the data. So we've seen that it's quite hard to get reversal even in this partial equilibrium model of the industry. It makes it's even harder to find reversal when you embed this into a macro model, when there are other channels of transmissions that do not go through the banking sector. So the next step is to embed this banking model into a macro DSG model with many other features, and that allows us to also go more quantitative with the analysis. I'm not going to go in detail here. I'll just focus, I'm probably running out of time, focus on the key results from the model, which is in this set of graphs here. So the black line here shows what happens in response to a large recessionary shock when there is a strict zero lower bound on both deposits and on the policy rate. So both the deposit rate and the policy rate are constrained at zero. This central bank, which follows a Taylor rule, cuts the policy rate to zero and leaves it there for about 6 quarters here. The blue line shows what happens when there's no lower bound at all, not on the deposit rates and not on the policy rates. And in this case, the central bank ends up cutting the rate to about 75 basis points. And finally, the red line shows what happens when the policy rate can fall below zero, but the deposit rate is bounded at zero. The central bank here will actually need to cut rates more aggressively to almost minus 1.5%. And this is because the bank lending channel in this case is weaker than it would be if there was no lower bound on the deposit rate. But the overall transmission mechanism still works in the right direction, so the central bank just needs to cut the policy rate more than in the previous case. So looking at lending rates here, in the third column, the red line shows that with the lower bound on the deposit rate, even though the policy rate is cut more aggressively on the red line, the lending rate falls by less than in the blue case. And that's, of course, a funding constraint at work. There's a reduced but positive pass-through to lending. Bank equity, in the bottom left, falls in all cases. That's because of a recession. It's not because of the negative rates. If we don't do negative rates, that's the black line here, bank equity actually falls by a lot. If there was no zero lower bound at all, not on deposits or the policy rate, banks would be better off, and that's the blue line. And the other case is the intermediate one that would be the one we are discussing in this paper. And in terms of output and inflation, the ordering is, again, the one that you would expect. There is a bigger fall when there is a lower bound on deposits and policy rates, and the more benign case is the one in which there's no bound at all. And we can compare, look at the marginals here. We can compare the effectiveness of negative rates in positive versus negative territory. So we're looking at the cut in the policy rate when we are at positive levels. and that should be the blue line, and when we are in negative territory, that should be the red line. And when the cut is in negative levels, the deposit rate doesn't fall, the lending rate falls less, and output and inflation increase by a lot less. And this is done for a closed economy here without without any market access, market-based finance by firms. So all the intermediation is done through the banks, and the banks have some access to wholesale funding. Now let me show you what happens when we allow other margins or channels of transmission. And this is illustrated in this graph. In black, you can see the closed economy, which is the case we were looking at before. The closed economy when there's no market-based finance. So firms have no direct access to financial markets. They have to go through banks. In here, a cut to negative rates has a very limited effect, or a more limited effect on output and inflation. But when we introduce market-based finance in red, the effectiveness of negative rates increases. And moreover, when we add the open economy dimension in green through the exchange rate channel, this ends up amplifying the effect of negative rates even more. So let me just wrap up and turn to the conclusions and what we learned from the data and the models. Negative interest rates ease financial conditions and support growth and inflation. The effects on aggregate bank profitability seem to be limited, and that's what we get from the data, and that's what the model captures. It's quite hard to generate a lending reversal if you make realistic assumptions on how banks price their loans. It becomes even harder to get reversal as one moves to a more realistic general equilibrium model when there are other non-bank channels of monetary policy transmission. And bottom line is that as long as banks are partly wholesale funded, reversal in the aggregate is highly unlikely. Other general equilibrium channels continue to work and reduce the risk of lending reversal. And particularly so in open economies. Concerns about competition and financial stability when there are large differences in bank business models, funding models, might be a reason to pause or really to think of mitigating measures such as reverse tiering and the like. I'll conclude there. Thank you.
So let me thank the organizers for the invitation to participate this evening and to have the opportunity to discuss this paper. So maybe my first comment is I think this is year 20 or 21 of this series. And this is really, there's pressure if you get the invitation, because you can look back and see so many very distinguished economists and so many very good papers have been presented to the series. So I think Silvana can relax. Silvana, her co-authors, this for me passes the test. It's an excellent addition to this series. And this series, I think, has a distinct identity. Let me say, by the way, well, I don't know the full rollout, but Silvana already presented this at the AEA meetings in January. And I think it's always been, in these years, important that European economics has a visibility at the American Economic Association. And so the early version of this work was presented, which I think is important. But in terms of content, I think this series, the ideal paper mixes original new research. So it's not just kind of a repackaging. It mixes theory and empirics. And you saw today in the presentation the careful presentation of the empirical evidence was an important context here. And also, I think very helpful, I found it very helpful, is there's a comprehensive survey. So you can if you say, well, I need to know what's going on in this literature, both in the paper itself and how Silvana presented, you can see a lot of the papers are presented. Maybe I'll also mention in terms of the context, monetary policy has featured several times in this series. And coming from the ECB, I think it's so important that academic external work on monetary policy is supported because we have lots of good economists. The Bank of Spain has lots of good economists. And we have an advantage that people who work in the central bank know a lot. On the other hand, there is a risk of being captured by the groupthink. So having the external rigor, and this is where the fact that this is not just, of course, the foundation is fantastic, but the Journal of the European Economic Association is a super tough journal. It's one of the highest ranked journals, and I don't know if you've already been through the referee process, but in any event, it's an important badge of rigor. So let me make my first kind of substantive point, which as you heard in the presentation, the main focus here is on the banking channel of monetary policy and of negative rates. And I think this has not always been so easy. You might say, well, it's obvious. Europe is a banking-dominated economy. Of course, banking should be at the center of macroeconomic analysis and monetary policy. But actually, what's interesting, has never really been central because it's very difficult to introduce banks in a real way into a monetary policy model. So if you look at your undergraduate textbook, banks are not there, the financial sector is not there, and it always sounds very strange when you look at a macro model and interest rates primarily work through intertemporal substitution. And you say, okay, I don't really recognize, is this the way the world works? And so one of the important features here, which is done in a multi-level way, starting off with partial equilibrium, but then moving to general equilibrium, is having a kind of interesting banking sector. Of course, you can add banks in a trivial way, but to add an interesting banking sector, which has this fundamental heterogeneity in terms of the different business models, I think that's an important achievement here. And again, coming back, it's important to have a model which has, I think, features that are intuitive, but also in the end work well in matching the data. So maybe, so this is a universal paper because, of course, BOJ has done negative interest rates, Sweden, Switzerland, Denmark, but I'm just going to focus on the ECB being very narrow-minded. But let me make a few points which are fully, I think, reflected in the paper. But you know, of course, for the students here, the researchers, there's still a lot more to do. So if you look at the graph on the left, this is our policy rate, which went to zero in 2012. Then, you know, essentially, the novelty here is it took 2 years to go from zero until June 2014, when it went all the way to an amazing number, minus 10 basis points. Then it took, then very quickly, once you get going, you get going. So they doubled that, a gigantic increase or decrease to minus 20. And then it stayed at minus 20 from September 2014 to December 2015, minus 30. That was my first meeting at the Governing Council, by the way. So that was an interesting move. And then because that period, late 2015, early 2016, was a super interesting time in the world economy. There's a lot of concerns for various reasons. And that did prompt a move in March 2016 to minus 40. And then we stayed there for 3.5 years, only going to minus 50 in September 2019. And that's at that point, I had become the chief economist. So, of course, you might say, why do we have a presentation? Why do we have so much work about 50 basis points? When, if I look further along, you then did a 450 basis point hiking cycle. Then you've done a cutting cycle back down where you've knocked off 175 basis points of that. Compared to the variation in interest rates recently, what was the role of this fairly dragged out decade of moving between 0 and minus 50? But what I'm going to show is actually it was very important, and I'll get to that. Now, what's important to say, and I suppose this is the overall philosophy at the ECB, and I don't think it matters for what Silvana did in terms of showing how the bank lending channel works. In terms of the first order. So the first order mechanisms are captured, I think, in the model that has been presented. But if you want to also go beyond the first order and have a complete picture, I think the interaction with the other policy tools is important. So in June 2014, there was more forward guidance offered. So I'll come back to forward guidance. June 14 was the launch of the first TLTRO program, so the targeted lending program. And then it took a few months after June 2014, but in early 2015, the ECB adopted QE, so the asset purchase program started. Now, I don't show going back that far on the right side in terms of the balance sheet, but just as a reminder, kind of at the peak, we had the APP over 2 trillion, another 2 trillion in TLTROs and 2 something in the PEP program. So at the peak, we had injections of 7 trillion euro, and that at the peak was 44% of euro area GDP. So that's not a small number. Again, the reason why I make that point, I'll come back to. Okay, so maybe again when we think about, and there's a nice kind of building up of these points in the paper, is what we mean by the lower bound has different meanings. One is, of course, and traditionally there was a sense of a physical lower bound, and this is also noted in the introduction to the session. People kind of assumed people would, if you try and push interest rates below 0, people, in terms of depositors won't accept that because you always have the option of holding cash. So cash returns 0. Why would you ever take less than 0 on a deposit? And so this issue of deposits is important. What I write here is it's a special role. It's not an absolute issue. It does depend on the context. We know for corporates, they were, in the end, had no good options. If you have a very big balance sheet, you're not going to start building warehouses to store a lot of banknotes. It happens to some extent, but not of the scale of what the global corporate sector needs. And for households around Frankfurt, the ECB staff felt it because even at not that big a deposit number, eventually the banks started charging households negative rates. But in many countries, there's a consumer protection prohibition. In many countries, there's a political economy. It just feels wrong. It feels wrong to charge negative rates on people. And that political economy dimension is relevant. So in any event, what's interesting is in some countries, like in the US, it really continues to be a 0 lower bound. There's a sense that the American financial system, American society would not accept below 0. And that's a very interesting question because what Silvana showed here is that going below 0 can be quite effective. And if the alternative to going below 0 is having to max out on QE, which has its own headaches, this is a very interesting question. Why is 0 an absolute prohibition? What I liked myself to think about is the conditional lower bound. Because, of course, people, and we still don't know what exactly is the real effective lower bound, where it really is the case, okay, you say, I'm not going below that. And so what we had was a search. Initially minus 10, then minus 20, then minus 30, then minus 40, years later it's minus 50. There's always saying, okay, are we sure we can go lower? And say, conditional on what we know today, are we comfortable with the fact that we can go lower? So let me emphasize throughout this period, the ECB always tried to maintain the signaling, we can go lower. We're not at the effective lower bound, we can go lower. And that signaled to the market that this is not the lowest of the low is important for signaling value. Maybe one point, Silvana showed it, but it's in the text as well. It's important also when we look at individual countries to recognize that if the world had a common shock, the world, because one of the ways negative rates work is through the exchange rate. The world does not have an exchange rate with the universe until, I guess, Mars gets populated. So the exchange rate channel does get switched off at a global level. So an important point here is, and politically, and if I go back to early 2016, there was a lot of debate when the BOJ was looking to go negative, we were looking to go more negative, about the negative spillovers to the world through the exchange rate channel. And there's a famous speech by Mark Carney from that point. So in any event, let's imagine we find out the effective lower bound for any one country is closer to -1 than to 0. That doesn't mean the world can go to -1. I think that that's important. But as was also in the presentation, it's also important to remember, even though banks are very important, there's many other channels, not just the exchange rate, to the money market, the bond market, and asset prices. And these channels will work in any event. And again, to repeat, here the main margin of difference across banks is the business model. Are you deposit, how reliant are you on deposits, where retail deposits are kind of maintained to not go below 0, at the very least for kind of regular size retail deposits. And so, as Silvana presented, the key issue here, and this is why this is not so, from a macro modelling point of view, this is not necessarily straightforward to get there, but it sounds extremely sensible to say the marginal funding cost is a weighted average of the deposit rate and the policy rate. And of course, as again you said in the introduction, banks do have a mix of funding. They have deposits, they do have wholesale funding, and I'll come back to it. Of course, one type of funding for a lot of European banks in this period was TLTROs. It was us. And the TLTROs, which was linked to the deposit rate, did relax that deposit funding condition in an important way. And again, once you have that, I think the main result has to be true, which is so long as you're not 100% deposit funding, your overall funding cost does go down when the policy rate goes down. And so in the aggregate, lending has to go up. It's really hard to overturn that. So I think that this is very important to have, that even the banking sector will contribute to monetary easing in a negative rate world. There's extra material in the book in the paper about transition dynamics, because of course banks have pre-commitments. Let's say they have fixed rate loans versus floating rate loans. Let's say it depends what they do with their interest rate swaps, of course, and how active they are in the bond market, and so you can work through that as well. And then the last, you might say, well, why should they go through the pain of adding the full general equilibrium? But this is very important, because if these non-banking channels are stimulating the economy, if the economy is growing, then you're going to get more credit demand. you're going to have lower loan losses. And at the start of this, in those years, the mid-2010s, there was so much concern about non-performing loans. And then also through higher asset values. And then maybe, a lot of work has been done with the risk-taking channel, that essentially if banks have facing fairly low yield curve, they may be tempted to take more risk. That is part of the policy mechanism, but it's not as clean as kind of other dimensions, because of course more risk also creates financial stability concerns. That's a kind of calculated risk, and during these years it is heavily mitigated by the introduction of so much macroprudential policy across Europe. So any concerns that to be excessive risk-taking would be moderated. So in other words, the result here is basically saying, even if you tie your hands by turning off risk-taking, you still get this net positive macro effect. So, this is, I think, very important, and I'd say universal results. We value it at the ECB, but we also actually value the fact that this is not a euro area specific model. It's a universal global model, and that really kind of makes it, I think, more robust. Okay, so having, and this is usually, especially when you have a very good paper, you say, that's a great paper, now write another paper. But I'm not going to ask Silvana to do that unless she has spare time. But it's really an invitation to all the researchers here in the room and elsewhere that there are other elements to take on. And also, again, if you try to think about empirical work. So what other ways do banks differ from each other? One is the customer base. That's true in terms of the identity of depositors. Are you basically collecting a lot of small deposits? Do you have a lot of corporates? Do you have a lot of financial sector deposits? And so on. It clearly matters what kind of country you're in. Low income, high income, it makes a big difference. But it also matters in terms of firms. And again, if you go through this period, the reason why all of this was necessary is the world and Europe was growing very slowly at this time because so many firms were in trouble after the financial crisis. So many firms needed to delever. So many firms had bad balance sheets. So many households were dealing with excessive mortgage debt. So understanding not just the banks, but the customers of the banks and how they would be affected by low interest rates was very important. The loan book, it's really striking across Europe, the differences between floating rate countries and fixed rate countries. And again, that makes a big difference. There's a big difference via bond holdings. When rates go down, the value of bonds go up. And again, let me say, of course, that's true for a risk-free bond. It's even more true in the European context when there's so much high sovereign spreads at this time. So having a really big improvement in the bond market condition was so important. There is this issue which connects to the reversal rate issue, but I'm tempted to leave it all to Raphael to say something in the discussion about the mechanism via both current and future profitability, levels of capital, and some people use solvency in a kind of narrow way. But again, at that time, now we think of banks, including today's financial stability review of the ECB, everything's fine, people have high capital, we're far above minimum requirements. At that time, there was a lot of solvency concerns, which was important. Differential liquidity, that means has different interpretations in different contexts, but and I'll come back to emphasize, the gold star of liquidity is central bank reserves. And at this time, central bank reserves were greatly expanded through TLTROs and through asset purchases. I'll come back to that point. Okay, so let me pause here for the empirical people in the room. You might say, fantastic. I'm a panel data guy. I love variation. I can get my data set which has variation across banks. I can get my data set which has variation across firms, across households. Let me build this mega panel, and through the miracle of dummy variables, I can sort out everything. To some extent, that's true. There's a lot of papers. You learn a lot by looking at the interaction effects. Conditional on having a certain amount of liquidity, does the effect of negative rates differ? And you can add on interaction effects. Yes, fantastic. There is a limit. In the end, we need to know the macro answer. And the people who do those panel studies find it difficult to aggregate up. So if you say this kind of bank is hurt more or less, fine. In the end, what I really want to know is, in a world with variation across banks, what is the aggregate outcome? Are we going to see an expansion in the economy or not? And this is where Silvana, because it is, you bring it together, is very important. So anyway, if you're doing that kind of empirical work, try and do the aggregation at the end and get there. And then the last point is, business models are pretty sticky. It's hard to say, well, I'd love to be a kind of, a pioneer in some types of banking, but I'm just a retail deposit gatherer. But there is pressure to innovate. And one thing that was mentioned already was fees. So you may not be able to go below zero in terms of the rate on a deposit, but de facto you can collect more money from your customers through all sorts of fee proxies. Okay, so let me go back to say, well, okay, if you really want to fully understand how negative rates work, the interaction with these other policy tools is important. I'll show you a chart in a minute about the first point about why negative rates reinforce and are reinforced by rate forward guidance. QE and negative rates intersect in different ways. So for example, QE, because it compresses the term premium, makes long-term yields look not very much higher than short-term yields. And for many banks, they were concerned, okay, I make money off this yield differential. What happens when you compress it? They were not really expecting the answer, well, we can help. We can make the short end negative. So if you're only collecting 1 or 2% on the 10-year bond, you can still get a yield slope by putting the short-term rate negative. So we do think that helps. Importantly, if the problem is you're not able to take benefit of cheaper funding because you have too many customer deposits, expanding your funding through TLTROs, which would be priced on a formula connected to the negative deposit rate, helps. And that was very important. And in the UK, funding for lending has a similar role. Again, in the US, that mechanism has not been prominent. Let me just pause here for a second to say that last week we were both at the Federal Reserve event on Thursday, Friday. So you can interpret the paper today as having a companion paper because Silvana surveys QE and rate forward guidance in the Fed paper last week. You can find it on the internet. Okay, so the reason why I bring this up is a very important way negative rates have worked in this period is because banks hold a lot of central bank reserves, and in this time they were making payments to the ECB. There's negative rates on those reserves, and that has played an important role. I'll come to some of the mechanisms here. In 2019, we kind of moderated that a bit by tiering, by saying some of your excess liquidity will not be inflicted with negative rates. There's a trade-off there. This can help in some ways, it can hurt in other ways. And again, for those of you trying to find good research topics, that area about under what conditions is tiering a net positive is, I think, an important topic. So maybe what's interesting is this issue about, you might say, well, this sounds bad. Having a lot of central bank reserves which drain income because they pay a negative rate, that must be bad. It's hurting bank profitability. But this is tough love. is tough love, because it basically says, okay, do something about it. Try and get rid of those reserves, do more lending. And so this is what we think happened. And so this work by Tenreyro and others, it's called a hot potato effect by some people, which, by the way, turned into a very cold potato when we raised the DA4, and the banks could make money without doing anything, just by holding on to those reserves. And then maybe what's interesting, and again, for the euro area with 20 member countries, that effect of paying negative rates is on central bank reserves. But what's interesting about central bank reserves is they're identical everywhere across the euro area. More banks basically looked more and more similar across Europe because more and more of their balance sheet was central bank reserves. And if you are basically replacing a balance sheet full of troubled loans to local SMEs, full of domestic sovereign bonds, and then you move to a balance sheet where you hold a lot of central bank reserves, the upside of that is it basically improves in the phrasing of Kieran Rogers in this paper, it improves the collateral dimension of the balance sheet, because these are high quality assets. So as I just indicated, this issue about excess liquidity and interest rate policy has had a different conversation when we raised rates to 400, because people say, oh, this looks like a gift to the banks. But in terms of slowing down lending in the economy, it was quite effective. So let me just finish by advertising some of the ECB work. This is ECB work which is in the June 2025 edition of the Journal of Monetary Economics. So it's gone through that external filter. And Silvana's, because that screen is small, but this screen is big. And so what I show here, and this is really before the pandemic, what did the money market think in late 2019? So we brought the policy rate to minus 50. The red line is what they expected in terms of forward curve, but then around that forward curve is what they felt in terms of the risk distribution as captured by asset prices. So what you can see there was we had basically a super accommodative stance in the end of 2019. Not only was the rate today minus 50, it was expected to, in expectation, the red line is expected to be there for many years ahead. And also in terms of risk management by traders, they accepted actually it could go lower. It could go lower, it could go to nearly close to minus 75. So this is providing a lot of accommodation. So what this paper does and says, okay, is that negative rates on its own, or is that an intersection between negative rates and forward guidance? And they basically try and decompose that effect. And maybe I'll skip the upper right quadrant and go to the lower left quadrant. That's the counterfactual where you didn't have negative rates, but you still had forward guidance. So you've lost the minus 50 in terms of accommodation, and you've lost the option to go to minus 75. This is a lot tighter policy. But then when you go to the lower right quadrant, if you refuse to do forward guidance, people say, well, okay, that's today. What's going to happen a year from now, whatever. And you can see the forward guidance is very important, because without forward guidance, you have a lot steeper forward curve. So maybe coming back is, again, my bet is if Silvana and her co-authors extended the model to also include rate forward guidance, they would get even more powerful effects. But it makes sense to go one mechanism at a time in terms of the mechanisms. And what I would say also, if you extended the model here to recognize in the context of Europe at that time, which did have a troubled banking system, if you intersect negative rates with a lot of liquidity, if you intersect negative rates with a lot of support, stimulus to a troubled corporate and household sector, then the kind of reversal rate mechanism, which is lurking in the background somewhere, is overwhelmed by many positive forces. But what I would say, looking to the future, is you really do have to take that broad perspective, and this is why the ECB and the euro system has many people working for it, to really say, okay, what environment am I in? Am I in an environment where low rates really help? Or am I in an environment where the payoff would not be so big? But I think in the context of the decade which we had, this policy was very effective. So with that, let me congratulate again Silvana and her co-authors on a fantastic paper, and again express my gratitude to the Foundation and to the European Economic Association for the invitation.
Thank you very much, Philip, for a fantastic discussion. And you know, for those students in the room, I mean, he laid out a whole research agenda with many ideas for PhD thesis. And yeah, thank you. That was a tour de force. And I fully agree with Philip that the interaction with other monetary policy tools is super important. We don't address it in the paper, but it's definitely something, you know, to add. And you know, this idea that you can lower not just the short end of the curve, and also, you know, through QE also lower and forward guidance lower the longer end is also very powerful and can achieve much more accommodation than just you know, what I presented here. So there's that interaction can be very powerful, and it should be part of the analysis. Here we stayed at the more cautious end of the analysis, and even there, even though we try very hard to get the reversal rate, it was very difficult to do it. And again, the more you incorporate these other channels, the more difficult the effect will be. I think, I mean, Philip mentioned many things, and I cannot disagree with any. I mean, I'm in full agreement with all his points. On the exchange rate aspects, my only observation would be that expansionary monetary policy abroad should be also expansionary at home, even if the exchange rate limits. You know, there's some competition there over exports, but yeah, I think if we were to work out the general equilibrium effects and have and measure the impact of expansions in all economies, we will get an extra kick, actually, more than what Mark Carney talked about in his paper, this competition through the exchange rate. But yeah, we'll see if we can incorporate that. I will pause here, and I think we can take questions from the public. Thank you very much. On the reality question, I fully agree. And you know, fees are a form of negative rates at the end. I mean, you could make the equivalent. And I think there's some work in the ECB, you know, documenting fees. And my interpretation of our model is that we take a cautious approach or a conservative approach in there. We don't consider those fees, but you know, in a way we could incorporate them, and that will make negative rates even more powerful because you have more transmission and you are lowering effectively the funding costs of loans. On the model, you're right that we don't have an additional friction to the capital constraint. The only friction here is the lower bound on deposits, and we could incorporate it, and maybe this is where we're compensating and not being, you know, as conservative. That's something that we will think about. Maybe Philip wants to comment more.
Well, let me just come back to the fee issue, which is what's very important for people who are setting policy is this change is recognized. And you might say conceptually, to the extent the fee is capturing the convenience yield of the liquidity services provided by deposits. So clearly people know it'd be a major pain, especially these days where so much is, your salary goes into your bank account, so many direct debits. It's hard to avoid having a bank account. And so if the bank is extracting more of that surplus by charging fees, and if they are pushing it to the absolute limit, then, if we decide, well, actually, we can add on to that, we may hit an issue. So I think that technical change in the banking system is something that should be integrated. As for the students and those who are looking, there's a very similar discussion going on in the bond market, about what exactly does it mean to hold a US Treasury bond, for example. What is this, a pure financial asset where I look at the return, and how much of this is a convenience yield because I can use that bond for collateral services and so on. And so this is actually going back to theory of finance, but also the empirics of finance. This also comes up, by the way, and I don't know, here in this country, if your newspapers have a periodic story about comparing mortgage rates across countries and say, why can't we be more like country X, which is low rates? But if you look at behind that, often the country which seems to have a very low mortgage rate, the rate might be low, but there's so many fees when you take out a mortgage that the total cost, if you like, of holding a mortgage is much more similar. This practice of, and this is classic retail marketing, how much is in the kind of sticker price and how much is hidden in the small print is of course, something where the banks employ a lot of people to look at that. The issue about equity value of banks, the role of capital constraints, and so on, is something that in these years has been very important for the ECB. And again, we had a lot of discussion throughout this whole period, but we've also seen what's happened since. Because, of course, the share values of banks rocketed when we raised rates. So I think the evidence is in terms of the connection between net interest margin and now whether it's the true equity value of banks or how the traders value banks, but there is that fact. But it's also true, which is when you really get to it, how is a bank valued? What do the non-performing loans look like? And the resolution of non-performing loans, which was painful, it made such a difference to have low interest rates in this period. The value of troubled loans improved a lot, both in terms of what people were willing to buy them in the secondary market, but also basically behind that, which is my first point today, was the customers, the firms. If you have general equilibrium, easing of monetary conditions, the customers who are behind those non-performing loans look a lot better. Maybe I'll connect this to the concept of zombie firms. So many people said, with low interest rates, you're just keeping zombie firms alive. What's very interesting is if you look at any point in time, a set of firms who look to have a problem, that their interest payment is high compared to their revenue, whatever metric you want to look at. You look a bit later, it's very hard to predict which of those firms remain troubled, but a lot of them recover. So this idea that low interest rates were terrible because it kept many firms alive. In fact, it's usually a pretty good idea to keep firms alive. Most of them recover. And so, of course, you need the discipline of bankruptcy and so on. But I do think, and we have, I don't remember how much we put in public, we have this kind of technique to build up, okay, in the course of any year, how is the kind of value of a bank changing? You look at interest margin, but you look at volumes, and if you see a lot more volume on a small, you said this as well, with a smaller margin but higher volume of lending, makes a big difference. If you improve the valuation of the non-performing loans, it makes a big difference. Through the bond holdings they have, it makes a big difference. Through the assessment of their liquidity position, which is heavily influenced by central bank reserves, it makes a big difference. So I do think it makes sense for any one model to isolate mechanisms. But in the end, you were saying the real world. In the end, you do have to recognize banks are complicated organizations. And if you want to have an overall view of these organizations, you do have to take all of those steps, not just any one slice of that.
And if I may add something to your point on NIMs skyrocketing when policy rates increased. One thing that was different here is, as Philip was saying, I mean, we didn't see default rates as interest rates increased. Firms were in a very strong position. There were obviously other measures of support during this period that made it possible, and that's why we've seen, I think, this enormous increase in NIMs compared to, past experience. There was a lot of support. I mean, the other aspect is towards the end of, towards getting closer to 2018-19, we saw many large household deposit accounts for households also being charged negative rates. And I think we might see more of this in the future precisely because of the convenience cost and the digitalization of our economies. I mean, we do most of our purchases now online, and it would be very, very costly to send a check to our online retailers and have to translate everything to cash. I'll start with the first question then. That's an excellent observation. So our results hold for when the funding constraint is binding. And what we are saying, if you move in that sphere of funding constraint binding, you're not going to find get big changes in profitability. In fact, we get a small increase in profitability when we cut the interest rate. But that's working with that constraint. Once you relax that constraint, then we're in Rafael's world in which these two activities, deposit taking and lending, are completely separable, and we can see different behaviors that we're not necessarily studying in this paper. So I don't think the result, the observation that profitability increased for banks in the recent period because of the increase in interest rates is inconsistent with what I'm presenting here. The other point that I just made is that normally when you increase interest rates so sharply and so quickly, you would expect to see a lot more defaults, and we didn't observe that because most companies and banks were in a very good position, and there were other support measures that preventing those defaults from households and companies. So that also contributed to the big increase in NIMs. There was, there were other measures of support that meant that banks' profitability didn't have any counterbalancing effect that you would normally have when you increase rates so fast. Philip, I'll let you the other question and come.
So For those who've not seen, there's a famous, I think initially at Jackson Hole, maybe in 2022, I think, by these fantastic economists, Raghu Rajan and Viral Acharya. They did bring up this point, which basically, the details differ between America and Europe, but the basic question is common, which is, because people did not expect this to end. You know, before the pandemic, even, by the way, in late 21 when inflation had already picked up, in our surveys, in the market pricing, people expected rates to remain low for at least 5 more years, through 2027. Connected to that, they expected QE to be ongoing. So what happens when there's a very big different change in that regime? In Europe, it's different because it is QE, but also TLTROs. So there's a lot of funding, a lot of central bank reserves. Now, what's common between America and Europe is the QE or the reserves generated by QE is running down slowly. So that's one of the answers here is the banking system is not being asked to adjust very quickly to the loss of central bank liquidity. That was different with TLTROs because they ran off pretty quickly. By design, they were, but on the other hand, banks knew that. They knew that they were not there forever. So here, it's a very interesting question, is how do banks behave in a bank-dominated system like Europe versus how do banks behave in a market-dominated sector like the US? And I think, if I remember correctly, in the Acharya Rajan work, one of the big roles of banks at that time was providing credit lines. So in other words, lots of firms saying, you know, I can go to the bond market, I can raise equity, but just in case I want a credit line. That's a contingent commitment, which was not, and the banks did not have, here's a credit line so long as I have QE. It's here's a credit line for as long as I have my contract with you. So there was a concern, if you've made that basically promise to be available to lend, and then your liquidity picture changes, as you say, there's a liquidity dependence there about having to basically ensure they have enough short-term deposits to stand behind that credit line. That, I think, was less of an issue in Europe. They were making loans in Europe, and there is a different kind of a dependency there. But the biggest difference is European banks hold bonds. They don't hold bonds to the level American banks hold bonds. So the fraction of the balance sheet in America, which did face mark-to-market losses when bond values fell, was really big in America. It was there in Europe, but much less so. It's just mechanics. The fraction of the European banking sector balance sheet, which are bond holdings, including, of course, the fact that we hold a lot of bonds, and we replace bonds with super safe central bank reserves, which had no mark-to-market risk. So the European banking system, in the end, held a lot of central bank reserves. They didn't hold too many bonds which were losing value. And then there's a big question, which, you know, over time, there is an issue here. In America, it is an integrated banking system. You know, if you're in a regional bank and you get nervous, you can run to one of the big 5 global banks in America. It's easy. In Europe, we do think deposit bases have a national stickiness. Not totally. There's more and more now firms who are brokering cross-border deposits across Europe. But there is probably a stickier bank-by-bank deposit base. That has downsides, has some upsides as well in terms of stability. But I would say exactly this topic is one of the biggest, I think, active areas for research now. This is why I was trying to mention the fact you do have to look at jointly negative rates or positive rates with the kind of central bank reserve question.
Yeah, just adding to that, I think the Americans are technologically more advanced in the holdings of financial assets. I don't think it's unlikely that, increasingly we'll see Europeans also having less of that stickiness in deposits because, the apps are building up and people are getting more acquainted with those types of transactions. So, we're lagging behind, but maybe there will be a point in which you'll have to worry about those things as well, Philip.
When you start to think about when we started to tighten monetary policy, there was an initial set of questions in 2022, which is, if you end QE, which is the first step of monetary tightening, who's going to buy these bonds? And the answer is, if you raise the interest rate, people will buy bonds. They're super interested in buying European government bonds, and they're very interested still. One element of that question is, how do you step back from that very large intervention? And the answer is, if you're in a situation where you can raise rates, then you can step back. And that's, I think, a very important point. There is a second point, which probably is behind the question, which is, surely all of that liquidity, if you're raising rates, why are you tolerating so much liquidity remaining in the system? Why don't you drain it more quickly? And I think there's two answers to that. One, actually, paying interest rates on reserves was really effective in tightening monetary policy. It's the inverse of how the intersection of negative rates and the balance sheet stimulates lending. The intersection of raising rates and a large balance sheet really leads to a very rapid tightening of monetary policy. We've seen that. Credit in the area very quickly went to zero. It's super effective. So the effectiveness of monetary policy with a large balance sheet is reinforced. There is, of course, the losses. This European system have made losses in these years. Of course, there were a lot of profits made in the QE phase. So when you add up everything, which I'm not saying is the right way to go about it, we do have to remember one of the lessons is central banks know when they do QE, if it works, you're eventually going to be able to raise rates. And when you raise rates, you make losses on those holdings. But what is fair to say is that you need to make a lot of provisioning for that. Or you're behind that. If the government is reliant on dividends from the central bank, they de facto have to have their own provisioning plan, not to let day-to-day spending be dependent on those dividends. So what I would say is, of course, what happened with the pandemic and the war, where is just a really big increase in interest rates, was not within our kind of 25, 75 percentile range, to put it mildly. But it's important to take into account that if we try to move more quickly, I don't think it would be particularly helpful to do that. So having this kind of gradual but sustained shrinkage in the balance sheet, I think is, around the world, I think people look at it and say, okay, this is probably the most sensible policy to find. But maybe if I come back to the whole question, and this is when we were at the Fed last week, it did come up. If you are concerned about the side effects of QE, you have to be open to negative rates. Because if you're in that situation where you have to do something, none of these are kind of free lunches. And essentially what the ECB did was, we do a bit of everything. A bit of negative rates, a bit of TLTRO, a bit of forward guidance, a bit of QE. And basically, that's usually in economics, corner solutions is not the answer. You want an interior solution where you don't go to the extremes. And so, you know, I think your question is important. But coming back to the topic of today, it does say, you know, if you do a QE excessively, it can have headaches. But then you do need to think about negative rates as part of your mix.
I just want to add a couple of things here. So there's a quote by Blinder. He quotes a conversation with Volcker where he asks Volcker, how did you manage to control inflation? And Volcker jokes by creating a lot of bankruptcies. And I think that's what we haven't seen. It's been a very smooth tightening with, you know, very few accidents, and, you know, it's kind of the soft landing that one would dreamed. Just one footnote on your question. It's a very important question. I mean, at the end, what's the optimal size of the balance sheet? And it's not clear that we will go back to what, you know, the old level. And this is primarily a financial stability questions, and I don't know what, you know, what they are thinking. But you need to be ready to cover the liquidity needs of banks and any, you know, other speculative demand for reserves, as well as and, you know, be ready from a precautionary function, how much you need in the system. And I think this, as Philip said, I mean, central banks have been able to tighten significantly without encountering big accidents along the way, and part of that was that there was enough liquidity in the system to deal with those accidents. I think we can pause now, and thank you very much, everyone, for being here and for the questions, and have a nice evening.